Okay, so now let's dive into the details of these qualified plans. Let's really understand how they work, and let's even put some specific numbers to it. Everything you see on your screen here are different examples of qualified plans. Now, keep in mind the difference between an investment and the taxation of an investment. So when we're talking about qualified plans, we're talking about how an investment is taxed. So for example, your 401k is not an investment. Your 401k might have some mutual funds or some stocks, or it could even be a CD, like your IRA. You could have an IRA CD, or even like real estate inside of an IRA. So the actual underlying investment could be different on each scenario, but the taxation is the same. So when we talk about a qualified plan, we're talking about the taxation of your investments. And there's a lot of different ones. 401ks being the most common, IRAs being very common as well. Maybe you work for a nonprofit organization like a hospital or a school and you have a 403B or a 457, but these are all qualified plans. And all these qualified plans do two things. They defer the taxes, but they also defer the tax calculation. Now remember, we like to use another word. We like to use the word, instead of defer, we like to use the word postpone. Tells a little bit more of what's really happening here, right? So the question that you have to ask yourself is, what tax bracket will you be in at retirement? Remember, it doesn't really matter what your tax bracket is now, because you're putting all your money in pre-taxed and you're deferring it, or you're postponing it until you take the money out during retirement. So the real question is what tax bracket will you be in at retirement? Also, what type of deductions will you have during retirement when you're taking the money out? Maybe you have a mortgage payment right now, maybe you have kids at home, maybe you have all these expenses and write-offs now, but what is that going to look like when you're retired? Is your goal to have your house paid off? Or is your goal to have your kids move out eventually? If that's the case, you might be losing some of those deductions. Also, remember, a lot of people think that because they're going to be in a lower tax bracket in the future, then it's okay to postpone the taxes until later. But is that really your goal? We talked about that earlier. Is your goal to retire at a lower income than during your working years? I mean, most people's goal is to continue the same style of living throughout retirement, right? Now, maybe you're going to downsize. Maybe you're going to buy a smaller home, move to a state where it's cheaper to live. But whatever the case may be, you might have travel expenses to go visit grandkids, or maybe health issues in your later years. So don't always expect that your income is going to be lower during your retirement years. In fact, if you do what you're supposed to, your income should continue to go up. So I'll keep all of that in mind. Now, refer to the module 2, where we dive into the taxes in more detail to understand tax thresholds and tax history, to ask yourself whether or not you think taxes are going to go up or down in the future. And we'll take a closer look in just a minute as well. Now, let's look at some of these examples and put some specific numbers to it. So let's say that you're contributing $10,000 a year into your qualified plan. Now, for the sake of this example, let's keep the tax brackets at 30%, meaning that right now when you're contributing money, you're in a 30% tax bracket, and when you retire, you're in a 30% tax bracket. And let's look at it over a 30-year window, because I want to break it down in 10-year segments. And let's just leave it at 5%, because to be honest with you, the rate of return isn't that important for this particular conversation. So, well, actually, let's go back here. So if we click on the calculate button, first of all, your $10,000 is going to grow to $697,000 over 30 years at a 5% rate. But if I were to ask you how much money do you have in your 401k and you said $697,000, would that be accurate? No, because your share only is $488,000, because the IRS is your partner in this. Remember, they have an ownership in this, retirement account with you. So their portion is $209,000. Now, your apparent taxes saved, apparent meaning we don't really know exactly what your tax brackets are going to be throughout your lifetime, but if you stayed in this 30% tax bracket your whole life, which we know wouldn't be the case, but you would have saved $90,000 in taxes, but not really, because it was $90,000 at interest, meaning that this was money that you didn't have to pay in taxes, but that money compounded interest as well for the IRS. The IRS's ownership grew just like your ownership grew. So your account really is only $488,000 out of the $697,000. So keep that in mind. All right, now, how does the tax bracket actually affect the overall rate of return on your account? Now, this is a little bit confusing, and I remember the first time I saw this, it was a little bit confusing, because what do you mean by tax brackets affecting your rate of return? I mean, if you're earning 5%, aren't you always earning 5%? Well, let's take a look at this. Let's say that in the 30 years that you're saving money into your qualified plan, let's say that you're always in a 30% tax bracket, and more importantly, when you withdraw the money, you're in a 30% tax bracket. If that's the case, then when I click on the calculate button, you can see that you're always earning 5% in all of those years. This makes the most sense, right? But what happens if during the first 10 years of your life, you're at a 15% tax bracket? Or not 10 years of your life, but 10 years of your savings or contributions. So you get your job out of college, you get your first job with real benefits, and you get this 401k, and you start putting money into that 401k. Right now, we're going to leave the company match off for just a minute to keep this simple. But let's say that in the first 10 years of your contributing to your 401k, you are at a 15% tax bracket because your income's not quite there yet. Then the second 10 years, let's say that you are in a 25% tax bracket. And then in the last 10 years, when you're at your peak income earning potential, let's say that your income is all the way up to, or your taxes are all the way up to a 30% effective tax bracket. And let's say that you're fortunate enough to retire in the same tax bracket as when you were working, meaning that you're able to actually keep that same style of living, which would be the goal, is to keep this style of living throughout withdrawals, right? Throughout retirement. If that's the case, then by putting money in at a 15% tax bracket and taking the money out at a 35% tax bracket, you're really not earning 5%. It's more like 3.92 because you're losing some of this money to the IRS. Right? They're taking a bigger portion by you postponing the taxes from 15% to 35%. Right? Does that make sense? So if you're putting money in at a 25% tax bracket and taking it out at a 35% tax bracket, your overall rate of return is going down because you're giving up more money. So the amount of money that you're keeping, is a less rate, is a less rate of return in this particular example, right? So if you average them all out, you're really not earning 5% on all those 30 years. It's more like a 4% return because you lost some money by taking money out at a higher tax bracket. Now, let's say that you were able to take the money out. Let's say that they came out with like a 15% tax bracket in retirement and you were in this really low tax bracket. Well, now, if you were able to put money in while you were earning 35, or when you were at a 35% tax bracket, and you were able to take that money out at a 15% tax bracket, now that affects your overall return in a sense because you're getting more money out, right, by postponing those taxes. So it's kind of an interesting way of looking at how your overall rate of return, in other words, the amount of money that you end up with at the end, is not just a flat 5%. It all depends on the taxes along the way. Okay, so now let's look at how getting a company match could help things out. So let's say that we're getting a 50% match. So we put in $10,000 and the company puts in $5,000. Now we've got more money, all earning 5%. And if we're in that same tax bracket all the way through, then of course, we're now looking at an overall effective rate of return of around 7% because of that free money that we're getting for those company matches, right? Now, if we go back to the same kind of an analogy and we say, well, what if we're putting it in at 15, then 25, and then 35, and then what if we're pulling the money out at a 40% tax bracket, one of those examples that we were looking at earlier, then that really affects, once again, your overall rate of return, even with a company match. So even when the company's giving you a 50% match and you thought you were earning a 5% rate of return, look at the impact on these different tax brackets along the way by putting money in at a lower tax bracket and pulling the money out at a higher tax bracket. So you really have to ask yourself, do you think taxes will go up or down in the future? That's the big unknown, but that has a huge impact on the overall growth of your money inside of a qualified plan. Okay, now we've looked at this before, but let's take another look at our tax history. Remember, these qualified plans were really popular here when they first came out because everyone that was in this really high tax bracket wanted to postpone their taxes until later. Now, by kicking the can down the road from this higher tax bracket to this lower tax bracket, as we've seen already, they saved a lot of money. The question is, do you think taxes will go up or down in the future? If you think taxes will go up in the future, then you could potentially be postponing your taxes to a higher tax bracket. And of course, that affects your overall rate of return and how much money you get out versus what you're putting in and everything else. So for example, let's say that we have $100,000 in our 401k and you're in a 20% tax bracket. Well, in that particular case, then your share is $80,000, the IRS's share is $20,000. The problem is what if taxes do go up in the future? In fact, what if because you've become successful throughout your career and you got into this average, you got into the upper income tax bracket, and we look at the average now, 57%, the IRS's share is actually going to be bigger than your share when you go to take the money out. So depending on what happens during your career and whether you go from one of the lower tax brackets to one of the higher tax brackets, and if the taxes go up in the future, there's a lot of things that could happen during those working years that could affect that money you put in the first 10 years of your career. Now all that money, when you go to bring it out, a big chunk of that could go to the IRS. So you really need to understand this partnership that you have with the IRS and how those future taxes could affect your money. Okay, so how do these qualified plans compare with a Roth? Now remember, you could have a Roth IRA, you could have a traditional IRA, or you could have a traditional 401k, or you could have a Roth 401k. So there are other versions. There's not just Roth IRAs, there's also Roth 401ks and other things like that that allow you to put your money in after taxes and then not have to pay taxes in the future. So let's see how the traditional IRA or the traditional 401k would compare with a Roth IRA or a Roth 401k. Okay, so let's take that same $10,000. Let's look at our same 30% tax bracket in the beginning, right, when you're contributing and when you're withdrawing the money. 30% tax bracket on both scenarios, so taxes don't change in this example, right? And let's look at our same 30 years at a 5% rate. Well, if we click on the calculate button, we can see that $10,000 over 30 years at 5% is going to grow to that $697,000. So when you look at your statement shows that you have $697,000. That's pretty exciting. But remember, you have that partner, right? The IRS owns $209,000 of that money for a $488,000 net, right? Or your portion is $488,000. So let's say that we pay our taxes up front. So instead of being able to contribute $10,000, let's say we're only able to contribute $7,000 because we paid our taxes. Remember, at a 30% tax bracket, we would only be able to contribute $7,000 instead of $10,000. Now, logically, your mind might think, well, then $7,000 compounding interest instead of $10,000 is not going to be as much. And you would be correct. It's only $488,000. It's not $697,000, but it's all yours, right? You get to keep it all because you paid your taxes already. So the crazy thing is that it is the exact same number if taxes stay the same when you're contributing and when you withdraw the money. The question is what happens if taxes go up? What if they go up to 40%? Now all of a sudden you're still at $488,000 because you paid your taxes in the beginning when it was at 30, right? And your results over here in a traditional 401k or in an IRA is only $418 because you gave more to the IRS in this example, right? So keep in mind that this is the big question. What will your tax bracket look like when you're actually withdrawing the money during retirement? Okay, so now let's look at how a traditional IRA is going to compare with a taxable account. Now And remember, we spent an entire module talking about taxable accounts, and we know how inefficient they are because we're paying taxes as we go. And that money that we're paying in taxes is not growing and compounding, plus there's the opportunity cost and everything else. So we're going to assume that we're going to pay our taxes out of the account. So let's take an example, a simple example of the same $10,000 with the same 30% tax brackets, money going in and money being withdrawn, keeping it simple. And if we calculate this, we can see that our qualified plans are way better than our taxable accounts because we didn't have to pay taxes along the way. If we have to pay taxes along the way, it's a huge impact on the growth of the money. Even though we still owe some of that money to the IRS, our net take home is $488,000. Now, in our taxable account, remember, we're paying our taxes from the account as we go each year, which means that our growth is not as much. Pretty significant impact there. So your qualified plan is going to be much more efficient than an actual taxable account. Now, what if we could get a tax-free account? We've looked at this before. It's kind of like looking at the Roth example, same kind of story, right? Our $488,000 is all ours. We get to keep it all, right? Because, we've paid the $209,000 earlier as we earned the money, right? So it's all growing tax-free, 488 net, 488 net. The question is, what happens when taxes change? If taxes go up in the future, then of course we can see that we're way better off to be inside that tax-free environment. So it's all about those future taxes, which of course we don't know. Nobody knows what the future taxes are going to look like, but you have to look at the amount of debt that we're in. You have to look at how much money the country's printing, and you just have to ask yourself, do you think we're going to be in a better situation in the future, or do you think we're going to eventually have to pay the price and get out of the situation that we're in? So ask yourself that. And then finally, let's take a look at some important questions to ask yourself. Number one, what tax bracket will you be in at retirement? That's what this all boils down to. Nobody knows, but that's the question to ask yourself. Also, what deductions will you have when you take the money out? Are your kids going to be out of the house? Are you going to have your house paid off? Those kind of things. And then the final thing that I want you to think about is, what is your exit strategy? So we know that we have to pay some of this money to the government at some point, right? Are we going to do that through our required minimum distributions by taking that money out during retirement? Are we going to try to figure out how we're going to leave some of this money to our kids? And if we die, is all of that money going to be counted as income when we die? Those are all some things to consider. Or do you want to think about it now? Do you want to make some changes to your qualified plan? Maybe you only want to put in what the company is matching and not a penny more than what the company is matching. And then maybe you want to look for some other options with the rest of your money. Or maybe you want to take the money you're contributing and put it into the Roth side of things, like a Roth IRA or a Roth 401k. And then if you have a match, maybe the company can put their portion into the traditional side so they can get their tax deduction. So there's a lot to consider to be able to plan ahead and try to minimize those taxes. Now remember, you have access to our calendar. You can book an appointment with us anytime if you want to run your numbers, or if you want to look at your situation and you want to ask some questions and you want to see what is the most efficient for you to get the most out of your qualified plans. We're happy to meet with you. So thanks for watching. Let's move on to the next lesson. And like I said, if you want to talk with us, book an appointment anytime.